Hey everyone, welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on December 2nd, 2025. And on today's episode, what's going on with Bitcoin, the risk of illiquidity, and remembering a stock market legend. So at the outset, I want to say I'm an investor. I'm a long-term investor. I look at assets that are producing cash flows. So that means businesses, the stocks of businesses and public and private markets. That means bonds, and that means commercial real estate. And I really don't venture outside of that. So the 800-pound gorilla in the room over the last couple of weeks has been Bitcoin. And Bitcoin, which reached a high of around 126, I want to say back in October, and it was trading maybe even down below 80,000. I know as of yesterday it was trading the high 80s. I checked it this morning. It's up over 90. It's always been an incredibly volatile asset. And I was very hesitant to comment on it because I'm really just a spectator in this whole arena. But I was starting to read about, there's a company called Strategy, or it used to be called MicroStrategy, and this guy Michael Saylor. And basically what this company pioneered is this idea of a corporation owning Bitcoin. So rather than owning Bitcoin through like a traditional investment fund, and it's called the treasury Bitcoin strategy. And it never made any sense to me as to how it was kind of working. But a few months back, Saylor looked like a genius. There was talk about Strategy being added to the S&P 500. Now the talk is very much reversed. And one of the things, I think I mentioned this a few weeks ago, there was a short seller named Jim Chanos who had actually shorted Strategy stock, bought Bitcoin as a hedge. And although I don't know the details, he exited that position. It was reported that he exited that position with a very hefty profit. But basically the thesis was that Strategy has a software company that basically breaks even, if not generates a modest loss. So the proceeds that they're using to buy Bitcoin is they're doing it through share issuance, they're doing it through the issuance of preferred stock, they're doing it through the issuance of debt. And that worked for a time because Strategy shares were selling at a very large premium over their per share value of their Bitcoin holdings, which is really the only value of the company. Again, if they have an operating business that's not making money, there's really no value there. There might be some liquidation value, but there's really no value as an ongoing enterprise. So Strategy is just one big bet on Bitcoin, and this worked for a time. I think they own like 3% of all outstanding Bitcoin or thereabout. But it was working for a time because Strategy shares were selling at 2 to 3 times the value of their Bitcoin holdings. And because the stock was so expensive, it was basically, in other words, selling at such a high multiple of their Bitcoin holdings, it was basically a very cheap currency. So Saylor was able to use that currency, issue more stock, buy Bitcoin, and for a time looked like a genius, and it started to really unravel. The Financial Times had a good piece on this called The Infinite Money Glitch, Meet Arithmetic. The idea of the infinite money glitch comes down to what Saylor was talking about as long as their stock price would sell at a high premium to their Bitcoin holdings, they had this discounted currency with which they could use to buy Bitcoin. And a couple things was happening. One is you had a lot of imitators. So I know even Grant Cardone, who has some private real estate funds, is now advertising that he's using those private real estate funds. He's using the rental income or the dividend income from those private real estate funds to buy Bitcoin. So he's kind of selling this Bitcoin strategy. You're hearing more and more companies get on board with this. So it's kind of diluting the strategy in a lot of ways. But one of the things that this article points out is that right now Strategy is part of the MSCI index, and this is a global stock market index. And like any index, they have a committee that will decide what will go into the index, what will be removed from the index, what will remain in the index. That committee meets periodically, and they make those decisions. And there's a lot of talk about strategy being eliminated from this index. Now, what you have to understand is that when you have an index, because there's so many index funds and mutual funds that will buy a big part of the index and exchange traded funds that buy the index, you always have this level of artificial demand anytime a company is a component of an index. So if that stock gets kicked out, and there's a good chance that it will, you're going to have a lot of forced selling. And what does that mean for strategy stock? What does that mean for Bitcoin? I don't know, but it's possible that this unwinds a little bit. Now, I will say, as a stock investor, if I really believe in a stock and that stock goes down, I'm actually happy because I can buy more. And over the years, our cost basis, or what's called the weighted average cost basis, has always been a lot lower than the initial buying point of a stock. In other words, if I buy a stock and that stock goes down and I still believe in that company, I've done my analysis, I think the market is wrong, I'll buy more, and then my weighted average cost will be less than the initial price that I paid on the first trade. And I think if there are true believers out there with Bitcoin, that'll probably happen. So I wouldn't, and I'm speaking ignorantly here just to be clear, but I just think that there are a lot of true believers, and it's also become a much more accepted asset, especially with the current administration, which has been very favorable to cryptocurrency. So my point is, I think you have a lot of potential risks, and I also think you have a lot of potential things that can stabilize it, but I would be very surprised if the whole Bitcoin treasury strategy, regardless of what one thinks about Bitcoin as a standalone asset, I would be very surprised if this Bitcoin treasury strategy is still a thing in any material way in, say, a year or year and a half from now. I could be very wrong, but when I look at strategy, or what we used to be called MicroStrategy, I see this thing kind of breaking down. I could be wrong, and I could be wrong quickly, but it doesn't strike me as at all sustainable. This company is trying to service debt with no income. I mean, they just issued some additional equity, and they're putting that money aside in order to service debt. So this looks like a very unsustainable thing. Just a warning to investors, but again, I could be wrong, and there are probably some true believers who still think Michael Saylor is a genius. One thing that I will point out, and this was in this article, MSCI is talking about dropping them from the index. This committee is talking about dropping them from the index because essentially you can't have investment funds in the index. They have to be operating businesses. So Saylor is trying to say, I think he's made some tweets on this or wherever, he says, strategy is not a fund, not a trust, and not a holding company. We're a publicly traded operating company with a $500 million software business and a unique treasury strategy that uses Bitcoin as productive capital. The problem is, of course, that contradicts a lot of things that he had said before. So he's trying to deal with the true believers who are part of his shareholder constituency, and he's trying to deal with the MSCI Index Committee. And it's very hard to serve two masters, so we'll see what happens. But I'm certainly in the skeptic bucket here. So that said, another big issue that's been happening throughout the year that I've been talking about, and that is this coming. I think it's going to be a coming deluge of private funds are going to be on offer to individual retail investors. Jason Zweig at the Wall Street Journal, he had a piece, and this is actually earlier in November. I wanted to discuss this earlier, but didn't get a chance. There's a little story about, it's this guy that worked at Vanguard. He was like the head of their fixed income or something, but he's down in Florida. He's down in a small town in Florida. He's retired. So when he was at Vanguard, he oversaw like $750 billion, according to the article. And he's now down in this small town in Florida, and he's vice mayor. His name's Robert Owerter. But he used to oversee this huge portfolio of Vanguard. Now he's overseeing this little $21 million municipal fund. And this municipal fund put some money into a private real estate trust, private real estate fund. And essentially they're having a really hard time getting their money out, because the way private real estate funds work is, of course, they're investing in illiquid assets. So I think in $1 million investment, it said they took 64,000 out or something, because the funds have the ability to close any liquidity off to investors. They can just, they can just say, we're going to limit you to taking out a certain amount. And this is one of the points that Zweig makes, is that institutions can bear that illiquidity risk. They can keep money tied up for a long period of time, and individuals really can't. And I've never liked private real estate funds, because unlike public REITs, public REITs can sell for below net asset value. So you can get a bargain with public REITs. Private REITs generally sell or offer shares at net asset value. And in addition, you're bearing that liquidity risk. You're bearing the risk of not being able to sell your holdings in that. You have to wait for them to sell assets, or possibly the portfolio can go public or being taken over. But you've got to be able to tie up your capital for a long period of time. So there's a lot of concern, and Zweig highlights this, that individual investors are really not going to understand that illiquidity risk going in, as these things are put together more on offer for individual investors. They're already on offer even for smaller investors through something called Regulation A+. And I know a handful of people who are doing this, where they're offering shares to smaller retail investors in these private funds. The amount that can be invested in them is relatively small, so that's been one of the saving graces. But this is an area of concern as it becomes wider, more acceptable. I was reading this book by Bob Pisani, and I'm in the process of reading this book because I'm developing a stock market investing course that we're going to roll out in the spring. It's actually our second course. We're in the process of rolling out a few others. But this is a course that I'm working on, and it's going to take me a little while. But one of the things that I'm doing is I'm relying on some material to look at the evolution of the stock market in general. Bob Pisani's book is very good for this, because Pisani was, up until recently, the senior market, I don't know what his exact title was, senior markets correspondent for CNBC. So anybody watching CNBC knows who Pisani is. He was on the floor of the New York Stock Exchange reporting for, 27 or 28 years. This book came out in 2022, so it was 25 years of his experience, because he started in 97. So the book covers all of his experience on the reporting from the floor of the New York Stock Exchange over that period. And I know 97, depending on how you look at it, it feels like yesterday for a lot of us, but it's unbelievable how much the market has changed. When he starts reporting in 1997, 80% of the transactions that occurred on the New York Stock Exchange occurred actually on the floor. So when we think about the New York Stock Exchange, I think a lot of people think about that physical location on, I think it's Wall Street and Broad Street, and all of the traders, yelling at each other, and the little pieces of paper everywhere, and being swept up at the end of the day. They still do that, of course, and they still broadcast from the floor of the exchange, but the amount of transaction volume that is actually handled on the floor is a pittance compared to what it was just a few decades ago. So I'm reading through this book to really prepare for this class, and as Pisani tells a story, when he starts in 1997, it was a very closed group of people. The floor brokers and stuff, and the runners and everybody, they did not want to talk to reporters. And that's very different than the way it is today, where the markets are very integrated with the financial news. But at the time, that was not the case. So two of the people that he was able to develop friendships with, one was a market maker for Berkshire Hathaway. I don't recall his name, but the other was a man named Art Cashin. Now, I knew who Cashin was because Cashin was kind of a staple on the floor of the New York Stock Exchange, and he was always on CNBC. He was on CNBC virtually every day. He was usually interviewed at market close. Cashin was the director of floor operations for PaineWebber, and then PaineWebber was acquired, so he became director of floor operations for UBS, which is the company that acquired PaineWebber. And he was very much an old-timer, very interesting. So I'm reading this chapter 4 of this book. Chapter 4, Pisani talks about his friendship with Art Cashin. And I knew that Art Cashin had died relatively recently. So I looked it up, and I kind of got goosebumps because literally as I'm reading this chapter, I hadn't thought about Art Cashin forever, but literally as I'm reading this chapter, and I looked it up, it was the 1-year anniversary of Art Cashin's death. He died at 83, December 1st, 2024. So I'm reading this chapter on the 1-year anniversary, and I thought I would mention something about him because he was a really interesting guy. I mean, I knew a little bit about him from all the reporting and all the commentary he provided on CNBC, but Cashin had never went to college. He started in the brokerage world at 17. He was helping to support his family. And he was very much known for telling stories. And he was a great market historian. He was an astute student of market psychology. And it was said that he could convey more wisdom in a couple of stories than could the most learned economist in a 1,000-page textbook. Right? He was just a treasure trove of wisdom. He reminded me a lot of some old-timer stockbrokers that I knew relatively early in my investment career. Very much a dying breed. I don't think you'll find too many people who can convey all these stories from back when. In chapter 4, Pisani talks about a story that Art Cashin tells about November 1963. And on this day in November 1963, November 22nd, 1963, I think everyone knows where I'm going with this. Cashin's on the floor of the exchange, and he notices that there's a lot of heavy selling by Merrill Lynch. And of course, at the time, we don't really appreciate this today, but at the time, you did not have an instantaneous news cycle. When President Kennedy was in Dallas, that wasn't national news. I mean, that wasn't a huge event. It became a huge event later. So he notices Merrill is doing all the selling, but there's no news coming on the newswire or anything. Well, it turns out that Merrill had some brokers in Dallas. They didn't know what happened, but they knew that the president's motorcade had been rerouted. And there was talk about the parade being canceled and everything, and they just kind of inferred that nothing good had happened. And of course, it came out later that the president had been assassinated. But this all happened. In other words, the market incorporated this before this ever hit the news wires. So Cashin conveys that story, and I think it's very interesting about how efficient stock markets can be in incorporating information. One of the other stories about Cashin that I liked is there was a spaghetti dish that was named after Cashin, and he showed Pisani the menu from like the 1960s. So the spaghetti dish was available for like $1.50 or something. But the spaghetti dish was actually Cashin's breakfast, because he would be out all night. He would be out all night drinking, and he would eat this spaghetti dish at like 5 in the morning. So another thing that reminds me of some of the old timers, because that's where I met a lot of them. Worked as a bartender when I was in college. Some of these guys would love their Doers and on the rocks and other drinks, but it's very interesting. So Yes, rest in peace, Art Cashin. He was not many people like him. I don't know if there's anyone like him around anymore, but it's certainly a bygone era. That said, I hope everyone has a great week. Best of luck to you in your investing endeavors, and as always, focus on the fundamentals.